The fact that when it did not break out where we had anticipated that it would, this E wave, and came back down to the channel, we knew if this pattern was going to bear fruit, it would occur during the next rally, which is why we actually positioned ourselves early on in this rally. But the confirmation will come as the market closes today, which is in New York in just a little bit of time, if it hasn't already. And then we'll go into, well, actually, it's Friday, so take that back. We'll go into the weekend. But as long as the close is effectively above this resistance line or at, I am strongly under the belief that we will see follow through next week and much higher pricing. I wouldn't be surprised to see silver move even higher than that. And here you can see this is my upside target right there, 42.30. And that's the first target. If it breaks strongly through there, 44 would be the next upside target above that.
Gold and silver markets are once again testing critical levels, with recent price action suggesting that the long-anticipated breakout may finally be underway. After months of consolidation and frustration for traders, both metals are now showing signs of strength. Gold has climbed steadily from its March 2024 base near $2,300 to retest all-time highs above $3,500, while silver has surged to levels not seen since 2013. These moves are not just routine rallies. They reflect deeper structural forces and chart patterns that have been building for years, setting the stage for what could become a defining move in the precious metals market. GaryWagner, a seasoned technical analyst, has been closely following these developments. Using Elliott Wave counts, symmetrical triangles, and candlestick confirmation, he highlights how gold's failure to break out earlier has now set up an even more powerful thrust. With resistance around $3,473 potentially turning into strong support, the next leg higher could carry gold toward $3,700 per ounce, while silver eyes $42 to $44 in the near term. Wagner points out that silver, long lagging gold, is finally playing catch-up, a sign that momentum may accelerate across the metals complex. This breakout may mark the start of a new chapter in precious metals, one where patience is rewarded with substantial upside potential. If you found this breakdown valuable, don't forget to like this video, subscribe to the channel, and share your thoughts in the comments. It helps us bring you more timely insights into gold, silver, and the forces shaping global markets.
We are looking at a daily Japanese candlestick chart. And of course, I'm using a combination of studies, but basically trend analysis, Elliott Wave, and pattern recognition, such as this symmetrical triangle that we're witnessing. And what we notice is we've had a runaway bull market. If we move it back a little bit, you can see that as you know, we're sitting at 2,300 in March of 2024. Not too much to move it to 3,200, 3,400. So we've got 1,000, and then it runs up to the all-time record intraday high, well above 3,500. Viewers, I am looking at a futures chart, so the numbers will be a little bit different than spot. Yeah. And then we knew, at least our model predicted, we were headed for a correction, and that's what I thought we would see. But typically in a correction, you get something like an A, a B, and then a C, and then you go back to the motive phase, a 5 count of bullish waves 1, 3, and 5. In between, you get corrective waves 2 and 4. But what happened was when we saw the market go up and hit this top, we had already drawn in the compression triangle and come down. We realized that this was not unfolding as a simple ABC, but something a little bit more complex. This is simply called a symmetrical triangle. The idea behind the symmetrical triangle, of course, is you're going to have a series of rallies followed by a series of shallow corrections, shallow rallies, until you typically get to the E wave. Following the E wave, as the model predicts, and not so well this time, you get what's called a thrust. A thrust is simply when prices break above, that's the wrong one, but is simply when prices break above the resistance line and you get that hardcore breakout. We certainly didn't see that. And so we watched gold go back into the channel. Let me just kind of blow this up a little bit. Go back into the channel and trade back down to the lower end of the channel. At this point, we realized since it did not occur here, meaning a thrust or a breakout, this would be, if it's going to do it at all, this would be the time. This is when we got our subscribers long at about 34.10. We had enough confidence that it's probably not going to break to the downside because, Jeremy, a symmetrical triangle doesn't necessitate a breakout to the upside or the downside. Either can happen. Typically, we see it go to the prevalent trend direction, which of course is higher, and that's exactly what we saw. Now, today, we're right at the resistance line. I hope our viewers can see it. I'll blow it up a little bit more, but as you can see, we've just gone over that a little bit. And so this was the breakout that I have been waiting for. And I believe that a solid close above, let's call it 34.73, will signal that we are going to see a strong breakout to the upside, moving gold substantially higher, even though it's already traveled from 33.58 to 34.78. So it's gone a significant amount, but we think that there's a lot more room to the upside right now. As long as we get an effective close above this resistance line, which it clearly looks as though that's a highly probable outcome. The fact that when it did not break out where we had anticipated that it would, this E wave, and came back down to the channel, we knew if this pattern was going to bear fruit, it would occur during the next rally, which is why we actually positioned ourselves early on in this rally. But the confirmation will come as the market closes today, which is in New York in just a little bit of time, if it hasn't already. And then we'll go into, well, actually, it's Friday, so take that back. We'll go into the weekend. But as long as the close is effectively above this resistance line or at, I am strongly under the belief that we will see follow through next week and much higher pricing. Well, you know, support is a funny character. Right now, the hard support's at 33.57. It's based upon this low. Resistance has been descending in terms of the trend line. So resistance has been coming down, and this will become the new support line once we get that clear break, which we have, but it's just above it. It's not strongly above it. I would expect that to happen over the next few trading days. Yeah.
Is silver confirming gold's strength and maybe leading the charge higher here?
Well, it's been lagging behind gold, obviously. Yeah. This, of course, is a daily. And what I was looking at, and I'll flash it back, was a monthly. So you can see the performance this month from 37.48 up to 39.72. Quite a move. 2.42%, excuse me, $2.42, up 6.5% over the month. And the thing is that this red line was drawn in yesterday because that's where silver had closed yesterday. And so we have not seen these prices really since February 2013. So we've not only taken out the big problem that we had with silver at 3,300. There was such strong technical resistance. There was also technical resistance at about 35, but it just sailed through there. And we'll go back to a daily chart so we can get a better idea of what we're looking at. $40 is our next anticipated level. We could encounter resistance. I'm not really expecting any real resistance there. Our studies right now are looking for $42 on the upside, and it is based upon not a daily, but rather a monthly. And so that's the thing. You can, as I said, we've got to go way far back, really compress this chart before we see the last time. Silver seems to have locked on it, but the last time was 2014.
Yeah, yeah. I was going to ask you. I mean, Gary, you pointed, I think, last interview, and you just mentioned it here, that $42 is the next real level to watch for silver. But I mean, with this new renewed momentum, looking at that chart, I mean, has that target now moved squarely into view for the third quarter?
It's definitely the bullseye target right now. Could it go higher? Yes.
Yeah.
It is reacting in a much more sensitive manner to follow gold, which it was not. Um, and now we're seeing it play catch up, so to speak. So
Hmm.
I wouldn't be surprised to see silver move even higher than that. And here you can see this is my upside target right there, 42.30. And that's the first target. If it breaks strongly through there, 44 would be the next upside target above that. Just because, for example, with gold, you have a marketplace that is near the all-time record highs, doesn't necessarily mean that it's time to sell into it or exit. You've got to pick your spots carefully, look at the range that's there, which is why this was a perfect setup, because you had the compression triangle series of rallies and corrections. So you could position yourself if you wanted to go long at the beginning of these particular rallies. Don't count gold out yet.
Hmm.
My upper level target, whether it's the end of this year, first quarter of next, and things are moving, is $3,700 plus for a troy ounce of gold.
Yeah. All
So
right.
I am quite bullish, and I believe that there's tremendous room to the upside still.
Yeah.
It's not
All right.
over.
The US dollar is exhibiting apparent technical weakness, and the chart suggests that the trend could persist. On a short-term basis, the 50-day moving average has been broken decisively, with similar weakness evident at the 200-day level. Historically, those breakdowns mark shifts from corrective phases into outright bearish trends. Using Fibonacci retracements from the 89 low to the 114 high, the dollar has already slipped below the critical 61.8% retracement and is testing the 78% level. If that fails, the target could be as low as 95, with the possibility of further declines toward 90 or even 89. What makes this significant is how sustained currency moves tend to be. Once trends like these emerge, they can persist for months or years, especially if the underlying fundamentals, in this case, inflation pressures, policy uncertainty, and waning confidence, remain in effect. The dollar index is heavily weighted against the euro, but weakness in this area ripples across all major currency pairs. For metals, the implications are bullish. Gold, silver, platinum, and palladium are all priced in dollars. A sustained decline in the greenback not only boosts their appeal on a relative basis, but also drives fresh demand as traders hedge against further currency erosion. With the dollar already down over 17% this year, the setup suggests precious metals could be in for another strong leg higher. Let's get back to the interview.
This is our simple 50-day moving average, and that's what we would look at for short-term market expectations. If it's above the 50-day on a short-term basis, we are in a solid bullish demeanor. The 100-day is intermediate, and then the long-term is the 200-day. And so I've highlighted the 200-day is in red. Green is the 50-day. It melted through the 50-day, came down and melted. You see how exaggerated the moves were on the days when it broke through the 50 as well as the 200. And so that's significant, because what that tells us is that on a technical basis, on a very long-term basis, the dollar is extremely bearish and has more room to the downside. In terms of targets, if it continues to drop 95, I'm basing that on a Fibonacci retracement data set that beginning of May at 89, up to the record top that we've seen recently at 114. And then the important numbers are drawn in. This is the 78% retracement. This, of course, is our starting point. As you can see, this is the 38. This is the 50. And the fact of the matter is, we're probably close to the We've even broken through the 61. And in terms of corrections, 61 is a very deep correction, but acceptable. 78 is acceptable, but actually fairly rare. And a break below 78 would mean that we're not looking at a simple correction, but a flip from a corrective expression in a bullish market to a fully bearish market. If we broke below 78, that would signal that. You notice also when you look at this chart, the 61.8, it comes down, it tests this area, it pops back up, and look, it finds resistance at the 50%. Then it comes back down, breaks through it, and you can see all of the attempts that came in. Let's go ahead and widen this. All the attempts that came in to break back above that, and all of them were unsuccessful. And because of that, that tells me the dollar absolutely has a higher probability of going down than going up. And the next target, as I said, would be about 95 on the dollar index. But there's been some incredibly significant traders through the ages, and ones that I would watch as I was young in the industry. One of them was George Soros. His political views are not liked by many, but he's a heck of a trader. I mean, he would go in, and if he believed that the Japanese yen was going lower, he would look for it to go lower from a half a year to a 2-year period. In other words, he would look for these big moves. Currencies, once they start to go into like a major rally, as we saw here, not a choppy market here, but we're getting there here, these trends tend to be defined and sustainable. In other words, the fundamental environment that caused the dollar to lose value, as long as those variables are still within the marketplace, the dollar will continue to drop. And it's dropped well below this. But right now, this 90, first, we want to see it break through 95, which I believe is more than doable. It's almost, as I see it, in the cards, unless something changes. But 90 and 89 is even probable and has a good probability of actually going out like that. Because you can see below that, we do have this spot at 88. If I extend it further, we can find points in time when it was lower. But I think right now we can see that it was a hard break below the 61.8. That's an important number. It attempted to retake that and to rally above it to no avail. And so if it can't move back higher, the course of least resistance right now is lower.
Yeah.
And so I am looking for the dollar to continue lower. Is it possible to see it be a sustained move? With the currencies, absolutely. You get defined trends that tend to last a good block of time. And the time that they last is going to be based upon what fundamentals were at play that moved the currency higher or lower. Because as long as those events are still present in the market, the currency will move in that direction and continue to go lower, as in the case of the dollar, until the variables that have brought the dollar down are no longer in the marketplace, are in the minds of traders or affecting the currency. And realize that the dollar index is traded against a basket of 8 currencies. Of course, the weight is not equal. The euro, I believe, accounts for about 50% of that. So you're really looking mostly at a dollar-euro chart. But there's 7 other currencies that make up the dollar index. So I believe that there's a high probability that the dollar will at least go sideways, most likely go lower. Well, the conviction that I have is that all of the metals you talked about, gold, silver, platinum, and palladium, are paired against the dollar. So there's going to be an effect, a strong effect, if the dollar continues to move lower, to move these precious metals higher on that part of the equation. There's 2 reasons that gold, silver, platinum, palladium will move higher. And one is sentiment, market sentiment by market participants, and the other one is dollar strength or weakness. So when you have a scenario in which the dollar has been exceedingly weak since the beginning of the year, it was at 109. Now it is at 97. It's lost, over 17% this year alone.
The US dollar's decline is no longer a minor correction. It is beginning to look like a structural shift. Breaking below both the 50-day and 200-day moving averages signals weakness across the short, intermediate, and long-term time frames. Add in the fact that the dollar has already fallen through the critical 61.8% Fibonacci retracement level, and the likelihood of further downside becomes difficult to ignore. A move toward 95 on the dollar index seems probable, with even 90 or lower on the table if the current fundamentals persist. And those fundamentals are not favorable. Inflationary pressures, policy uncertainty, and ballooning debt levels all weigh heavily on the greenback. Once currencies enter a sustained trend, history shows they rarely turn around quickly. The dollar's weakness isn't just a chart pattern, it's the market adjusting to deeper imbalances in the US economy. For gold, silver, and other precious metals, this is the perfect storm. They are priced in dollars, which means every tick lower in the currency adds upward pressure to metals. However, beyond the mechanics, sentiment is shifting. Investors are seeking safety in tangible assets as faith in fiat currencies weakens. With the dollar down more than 17% this year, precious metals are positioned to outperform in the months ahead. If you found this breakdown helpful, don't forget to like this video, subscribe to our channel, and share your thoughts in the comments. Your engagement helps us continue to bring you timely market insights.